Hey guys, Scott Phillips from Scott Phillips Trading here. At 6 a.m. in Bangkok, it's the start of another trading week. I'm finally feeling better, probably back to about 70%. You can see I've still got this big ass hole in my neck. They pulled the tube out of my throat though, and I'm not on dialysis anymore, so winning. Anyway, I want to talk to you today about sideways high volatility markets. So when we're designing trading systems, it's just completely unreasonable to expect anything to work in a trending market and a sideways market. Markets just don't work that way. The psychology is completely different. The psychology of a trending market is a positive feedback loop, and the character of a sideways market is a value market. Now, we have two different types of sideways markets. We have low volatility and high volatility. Now, the most important thing in reading any chart is to figure out what sort of animal we're dealing with. What sort of chart is it? Is it a sideways market? Is it a trending market? Is it a low, or is it a high volatility market? Now, this is a chart of December gold, front month gold contract. If we look at that, this is patently and obviously a sideways high volatility market. That ringing in the background is my kitten playing with toys, so don't worry about him. Okay, so what we have here is, this doesn't have to look like a perfect rectangle, and in fact it almost never will. So, excuse me one second. Say hello. Okay, it's patently obvious we have a sideways high volatility market. Now, if we draw a rectangle somewhere around the top of this support zone, you can see that we have three recent touches of that which have all been rejected. They've all been rejected with a retest and then a fall down a significant way down. Will this hold again this time? Nobody knows. But what we have here is a situation where if it breaks out to the upside from here, it's an extremely strong long. But right now, we have very good risk-reward odds to the downside, because we can place a stop . We can place a stop here. We can get in here. And we've got to a reasonable target somewhere down here. We've probably got 1, 2, probably 3 to 1 risk reward. That's probably about a 50% chance of getting there, maybe a bit less. Those are betting odds. So if you're a slightly more risk-averse trader, you could wait for what we see over here, which is a retest first, or here, which we see a retest first. Down the bottom, we see a retest at the lows. So at turning points, you nearly always see a retest. So if you don't want to be early, you just wait for the retest, which is actually what I'm going to do. Now, let's look at similar situation in the 2-year note. Now, we look at this and go, wow, that's just choppy garbage, right? Like, it's really choppy garbage. And it's choppy garbage with super high volatility. We've got massive big candles. We've got lots of, 1 red, 2 greens, 1 red, 1 green, 2 reds, some dojis, lots of dojis, lots of overlapping bars, big wide range on the thing. This is clearly a sideways high volatility market. So we've got this same situation. We've got the market trying to break out up here and just not doing a very good job. Now, we actually have some non-confirmation. If we look at, say, the 10-year note, you can see the 10-year note actually broke up above its old high, whereas the 2-year note did not. Now, and if we look at the 30-year bond, same thing, except the 30-year bond hasn't broken its old high like the 10-year note has. So what we have here is this principle is called non-confirmation. So when we have related markets like the 2-year, the 5-year, the 10-year, the 30-year bond, and one makes a high and the other doesn't, it's stinky for further upside. So let me explain the psychology. If the bond market is going to break out, if the bond market is truly strong, then the rising tide should float every boat. Every bond should be going up. But we don't have that situation here. Now, you can trade the 2-year, the 5-year, the 10-year, the 30-year. Which one do you trade? Really common question. Which one do you trade? It's axiomatic that if you're going short, you short the shittiest one. You short the losers, and you go long the strongest ones. You know, it doesn't work all the time, but the odds are in your favor when you do it. So here's how I'm going to trade this today. So one of my systems has a stop order to get short here with a stop loss here. It's a setup I'll be taking today, and I like it, and I hope you learn something. So thank you very much.